As a day trader, we need to have a very good understanding of all the trading strategies, setups, and how they work. One of the good example is the breakout pattern that give you the highest probability of a good trading, so you can make money. How to grasp the breakout patterns? There are a few types of them. One of them is that the breakout is strong, but it developed into a wide range. Let me show you how it works. First, we have a big breakout, like one big bar or even consecutive big bars there, indicating the market is very strong, either going up or going down. And then it follows by a pullback, and then we're expecting second leg up and the third leg up. Even if the first leg is very strong, it doesn't mean the second leg here or the third leg here are strong. We need to tell the market strength as the trend is going on and tell whether it is still very strong or it is weakening. If it is weakening, then our strategy will be a little bit different than the still strong trend. If the market is weakening, normally it's gonna develop into a wide range after their breakout, after the three legs here. So you can see that the market goes up very big for the first leg, but the second leg and the third leg are not as strong as the first leg. So this is a very good sign of the market being weakening. What is the characteristic of this wide range after the breakout pattern? So first thing is that the wide range will go down to test the top of the breakout bars or breakout consecutive bars. For example, here it's testing the breakout top here. And then the second thing is that based on the Fibonacci retracement, it's gonna retrace roughly 50% or even more. So this is how we can also tell that this is not a very strong breakout trend. When you see the market is going down to test the top of the breakout bar here, or the market retraces more than 50%, that means probably the breakout trend is over. Here is an example. First, we can see that there is a very strong big breakout to the upside. This bar is huge. That means the upside pressure, and then it is a very good breakout because comparing to the previous bars here, you can see the market was not going anywhere and suddenly there's a breakout. It indicates that probably there will be the second leg or the third leg. After this huge breakout, the market pulls back, second leg, pulls back, the third leg, and then the market developed into a big range here. This means the market is weakening, and then here you can see the trend is over. But when the market is still developing, how can we tell that the market is gonna develop into a wide range, and how can we tell the market is weakening? Here are the signs. First, when we take a look at the pullback here, you can see that the market goes up, small pullback with this doji bar, goes up, and then another bear bar right away. So there are small two pullbacks under this big pullback. That means the market is weakening. We can see the same thing. After the second leg up, we can see this small pullback, try to go up, and then go down again. There are two small pushbacks within the big pullback. So these are the signs that the market is not strong anymore, and then you want to reset your target if you set it too far above the bull bar here. How do we trade this breakout? After we see this huge upside breakout bull bar, we want to wait for the pullback. Here is the pullback with the doji bar a little bit downward, and then right after the pullback, we want to wait for the signal bar. So here is the signal bar. This bull bar is very huge. The body accounts for over 50% of the whole candlestick, so this is a very good signal bar. However, you can see the market goes down with the next bear bar right away, and if you put your order at the top of this bull bar here, it's not gonna trigger, so you're not gonna get into the market. And then what do you want to do? Wait for the next signal bar, and then next one, you can see this is another very good bull bar, which can serve as the signal bar as well. And then the body, even though roughly 50% of the whole candlestick, but it's leaning toward the upside. So you want to put your order at the top of this bull bar. After it finishes, you can see your order is get triggered, so it goes up for the second leg. After the second leg goes up, it doesn't go much, and then there is a bull bar as a small pullback. So probably the second leg is over, and then you're waiting for the pullback, and if you're expecting the third leg up, you want to trade again. So after this bear bar, you can see there is a bull bar. It's a hammer. So the body is at the top of the bull bar here. It can serve as a signal bar. So after you see this, you can put your order at the top of this hammer bull bar here, and then the next bar, even though it is a bear bar, it triggers your order, so you're in a position. However, the market goes down by 3 consecutive bear bars. Consecutive bear bars means the downside pressure, and it also means the upside pressure is weakened. The trend is not strong as initially anymore, but you can still trade. And then after this small second pullback within this pullback, big pullback, you can see there is another signal bar. This bar is very good because the body accounts over 60% of the candlestick and then leaning toward the upside. So if we want to continue trading, you can put another order at the top of this bull bar, and then it gets triggered, and then it leads to the third leg. Now let's talk about the stop. Stop loss is very important. Whenever you have a trade, you need to have a stop loss, and at the same time to have a profit target set up at the same time. This bull bar is a signal bar, but it didn't get triggered. The second, when it gets triggered, you need to put your stop loss at the bottom of this huge breakout bull bar right away. Even though it seems that it's far away from your entry point, but that's okay. If you put too near to your entry point, when the market goes up and down to fluctuate, it could get triggered and then stop loss right away. So, and then the market will take off. Then previously you could have a winning trade, but now you turn into a lose trade. So initially the stop loss should be at the bottom of this big bull bar. And then as the market goes up and take off, for the second leg here, you can put your stop loss at the bottom of the pullback here. So basically it's the bottom of this doji bar rather than the bottom of this bull bar. For the second leg pullback here, if you enter here, you see the market goes down, you may wonder, am I right to put the trigger here to enter the market again? Yes, you're right. If you get entered the market here with this bull bar, you need to still put your initial stop at the bottom of the first pullback bottom here, and then wait for the market to go up. If the market doesn't go up as expected, goes down to trigger your stop loss, I think you just take the loss because that's the name of the game. But if the market goes down again and then it goes up, you can also decide whether you want to add position at this moment with this good signal bar. After the market takes off for the third leg, you want to move your stop loss from the bottom of the first pullback immediately to the bottom of the second pullback here. How do you set the profit target? For the first pullback, you can set your profit target using the measure move. The measure move means you measure from the top of the first leg to the bottom of the first leg, and then measure up from the bottom of the first pullback here, and then the market probably will go there. However, as the market goes on, you need to observe the strength of the market and adjust your profit target accordingly. So in this case, when you see that before it takes off for the second leg, the two small pushback here, so you know the market is not as strong as before, so you want to readjust your profit target to a lower level. And then when you have the trade entered after the second pullback here, probably you don't want to do measure move anymore. Instead, measure your entry point here to the bottom of this actual stop loss, and then measure up by 1 to 2 risk there. You cannot go beyond 2 times of your stop loss for this bull bar here. Otherwise, you can see the market goes down, and then for a very long time it goes up again, but it will never go up to this point. So you could have a loss if you do not manage your trade correctly. Now let's have a look at the retracement. We measured the bottom of the first breakout bar here, and then to the top of the third leg. And then you can see that 50% is right here, and then coincidentally the market goes down to test this level, because this level is the top of the first bull bar here, or the first leg. And also you can see the second leg here, there are 2 small pushback, and then go up 2 small pushback. So probably when you trade for the second pullback, you can expect 2 small pushback. Normally the pattern will repeat by itself. And then also the pullback is weakening and the second leg is weakening, so you're expecting, okay, so the whole market right now is weakening, so at the top here, whenever there's a small pushback, probably you want to get out of the market right away. Weak breakout develop into a wide range in the end, but strong breakout would develop into narrow range, or there's no range at all. So in this video, I'm going to show you how to tell whether the strong breakout would develop into a narrow range. So first, there will be a breakout, very strong, either one big bar or multiple consecutive bars together. And then after that, there should be a small pullback. And then there's a second leg, pullback, and the third leg. It depends on the strength of the trend. It could develop into the fourth leg, but normally 3 legs are very typical. After the third leg up, normally it develops into a small range or narrow range here. The reason it's narrow because it compares to the whole trend here. You can see the market doesn't go down too much. So in general, how to tell if this is a strong breakout develop into a narrow range? First, each leg here is very strong, and then you can measure how much each leg goes up to, and then they're relatively the same. Another thing is that there could be the second leg or the third leg is much larger than the first leg. That means the trend is getting even stronger when it develops. Another way is to tell by the pullback. The pullback should be very shallow or very weak. So that means the trend is very strong. Why do we want to tell whether it could develop into a narrow range or wide range or no range? That is because if you're swinging your trade, you want to know when to exit or where. So by telling that this is a very strong trend, you're expecting there will be a small pullback, so you want to hold your position even longer to see the exit. But if the legs and the pullbacks doesn't tell you that it's gonna be a strong trend, then the market will go down too much, then you will prepare to exit as quick as possible to keep your profit. Let's take a look at this example. Apparently, this is a very strong trend developing into a narrow range. First, there's a strong breakout with this big bull bar. This bar is huge. It's bigger than any of the bars before it. So this is a strong breakout. Then we use the pullback and the legs to tell whether the strong trend is continuing. First, here is a pullback. Even though this is also a bull bar, but it serves as a pullback, very shallow, small pullback. This happens when the trend is super strong. You won't see a bear bar as the pullback. And then if we go to the second pullback here, we can see 3 consecutive bear bars. But it doesn't go anywhere. It doesn't reverse the market too much. So this is a shallow pullback indicating the trend is still very strong. Then what about the legs? The first leg here, you can see very strong consecutive bull bars, big. And then after this small pullback, we can see the second leg here, consecutive bull bars again, even though smaller but still very strong because it goes to the similar distance as the first leg. And then the third leg here. This third leg goes almost the same distance as the second leg and the first leg. This is also showing a very strong trend. Then next, you will expect when the market develops into the range for the end of the trend, this range will be narrow. So you want to make sure you exit at a very good level to take more profit. Let's do a comparison of the breakout developed into a wide range and the breakout developed into a narrow range. On the left side, you can see that this first leg is huge. Yeah. And then the second leg is smaller. Third leg is smaller. That's why it develops into a wide range. And also another way to tell is the pullback. You can see the pullback. This is small pullback with a doji bar, a big bear bar as the small pullback. These two small pullbacks forms the first pullback. This is the weakening of the trend. The same thing for the second pullback. There is a bear bar back and then a second small pullback within the second big pullback. So it's the indicator of the wide range in the end. So when you are at the top, so you want to close your position as soon as you see some sign that is going down. Otherwise, you can see the market goes down too much. So it's gonna eat your profit. Or maybe if you don't manage your trade well, you're gonna turn the winning trade into a losing trade. On the other hand, we can see when we compare these two trends, the pullback is small, leg is huge. That's why this range is relatively narrow. Let's use Fibonacci retracement to see how much the market reverse. We draw the line 0% and 100% and see each trend how much they go down to. Apparently we can see for the first trend, weak trend with a wide range, it goes back to touch the 50% level. But for the second strong leg here, after that it develops into a narrow range, it only reached back to 38%. Then how to trade? Where's the signals? This is the 10-minute chart. After the breakout, you want to observe for the pullback. After the pullback, the next bar is a huge, big bull bar serving as the signal bar because the body is accounting for over 60% of the candlestick. It leans towards the upside. That's why this is a very good signal bar. After the bar finishes, you want to pull your trigger to enter the market. If you didn't capture the first pullback here and enter the market, because sometimes it's really hard, there's no apparent pullback here, then you want to capture this pullback, the second pullback here. Or if you already in a trade but you want to add up your position to capture more profit, what you can do is that after these 3 consecutive bear bars, when you see this bull bar, it could serve as a signal bar because this is a strong trend. The stronger the trend, the less requirement on the signal. So you can use this as a signal bar, or if you are not sure, you wait for another bull bar here. 2 consecutive bull bars means the strength of the market, so you can use the second bull bar as the signal bar. Or even you want to wait for a perfect bull bar, this third bull bar can serve as the signal bar. But for the third bar, you may not be able to capture it because in this case, it's a relatively small signal bar, but it could be a huge bull bar. So that means when you wait for that bar finishes, the market is already at very high level. And another way is that you can adjust your time frame. So to lower time frame, you can see more details. So if we move to the 5-minute chart, you can definitely see that here is the breakout. And then what we want to do is that after this breakout, you can use the second bar here as the signal bar because this breakout seems to be very strong. And then the second bar here confirms the trend is going up because you can see the wick here is very small. It's going up. So right after this bar finishes, you can enter the market. Or even if you want to wait a little bit more to see consecutive bull bars here, and then here definitely you can see when the market slows down, this serves as the pullback. So after you see this bar with the top tail there, it can serve as the pullback. The next bar can serve as the signal bar, or even the next one, or even the next one. the similar concept as in the previous 10-minute chart. The same thing along the trend here. When the market pulls back here again with a hammer, it's a bear bar, and then the next bar is a bull bar. This bull bar can serve as a signal bar, enter the market, or even then any other pullbacks along the way, because you can definitely see this is a very tight channel. Tight channel is a super strong trend. It's similar to the breakout bars, like two consecutive big breakout bars. So that's why whenever there is a pullback here with the bear bar, the next bar, if it is a bull bar, you want to enter the market. Or even along the way, there's another very good signal bar, you want to enter the market. Or even if you can go down to even 2-minute chart or 1-minute chart to see more details, because sometimes you want to display multiple time frames together at the same screen to see which one you want to trade. So in this case, in the 2-minute chart, we can see after the big breakout bar here, there is a pullback, very apparent, with 2 consecutive bear bars. Right after that is another bull bar. So this bull bar can serve as the signal bar you want to trade after it finishes. Along the way, when you see the pullback, you also want to trade. However, this is a 2-minute chart. In the very beginning of the trend, you can use 2-minute chart to trade, but after maybe 5, 10, 15 minutes, you want to switch to a higher time frame. Do not trade 2-minute charts all the time, because when it pulls back, it will get you a stop loss. One good thing for the strong trend is that, as I mentioned, the legs are very similar. So that means the second leg and the third leg could go the similar distance as the first leg. This can be leveraged to take a profit. How it works is like this. For this chart, you can use this huge bull bar as the distance, as the measure move. You measure from the bottom to the top and see how far the market goes. And then next, this bar means the market is not strong as the first breakout bar, so you want to measure from the bottom of this bull bar to upside to see how far the market can go. So probably if you enter the market after this, you want to take profit at this level. You can also see that there is a bull bar with a very big tail here. That means some other traders are using the same measure move to take profit. They want to get out of the market and keep their profit. And then when the market goes up again, you trade again for this pullback. After the pullback, you want to measure from the bottom of the pullback to the top with the same distance. So this is the level you want to take your profit. And you can see that right after it goes up to penetrate this level, the market goes down. That means this measure move technique works for the very strong trend. Sometimes a breakout can be super strong that even it has the second and third leg, but in the end, it doesn't go back too much to test the previous pullback or even the previous breakout point. Instead, it develops into no range, or the range is flat. So this is a super strong breakout, and you can expect that the characteristic is the second leg here and the third leg are both very strong, and at the same time, the first pullback and the second pullback are very shallow. Let's have a look at this example. In the very beginning, there are 2 consecutive bull bars breaking out. The first bar is huge, and then the second bar, even though it is not as huge as the first bull bar, but the body accounts over 60% of the candlestick. That means still pressure to the upside. And now we have the first pullback here. 3 consecutive bars. The first bar is a doji bar with a big tail at the top, and the second bar is a bear bar. The body is super small. And then the third bar is another doji bar. These 3 bars forms the pullback, which means a very shallow pullback, and the strength of the upside is still there. Which means this is a big confirmation of the upside pressure is still very strong. And then we goes for the second leg here. The second leg goes almost the same distance as the first leg. That means the market is still very strong to the upside. And then here comes another pullback. The pullback with a bear bar even though the body seems to be big, like 50% of the candlestick, but the next bar is a bull bar. So reverse the bear right away. That means this pullback is also very weak. And then let's have a look at the third leg here. This leg, we see bull bars and bear bars, bull bars and bear bars alternatively. But this is a very tight channel. Tight channel means very strong trend. So even the third leg here confirms the trend is still very strong. So based on the pullback is weak here, and as well as the legs here are strong, we can see that this uptrend is very strong. And then in the end, see what? The market, instead of going down to test the previous pullback here or even going down further, it doesn't go down much. And then you can see it develop into the flat range here, or even we can call it no range. For the strong trend, how do we trade? Theoretically, if the trend is super strong, you can enter anywhere to take the profit. However, if traditionally we trade the pullback, this is the very good signal bar after the pullback, because the body accounts 60% of the candlestick, it's leaning towards the upside. And if we wait for the second leg to finish, here's another signal bar. The same thing, it's leaning toward the upside. And then after that, it develops into a tight channel here. And for the exit, you want to measure from the bottom of the first leg and then measure up to see 2 times from here. So you can take the profit roughly when it pulls back again here. Let's do a comparison of the breakout and how it develops into the ranges. For the first bar here, we can see there's a very big strong breakout here. However, the second leg, third leg are weakened and the pullback is huge. So that's why it goes back down to test the first breakout bar here. So it develops into a kind of a wide range. But for the second one, we can see that the first breakout, second leg, and then third leg, it's very strong because there's no obvious pullback for the first leg here, and then the pullback for the second leg is very shallow. That's why it comes down to test the pullback for the second leg here, but it didn't go down much further. For the third one here, you can see that even though we do have the pullback, obvious pullback here, but all the 3 legs are super strong legs, and then that's why it doesn't come down too much. And between the narrow range here and the no range here, what's the difference? This narrow range always happens in the forex and the futures, but for the no range here, it normally happens with the index futures. Even though sometimes breakout give you a very high probability of getting a profit, but it's not necessary that the breakout has a second leg. For example, there's a breakout, it's very strong, but after the first leg, it's gonna go sideways. There's no trading opportunity after the first leg. So in this case, there's only one leg, and if you see it's going sideways, the idea is to get out of the market as soon as possible. Here's an example. This huge bear bar is a very strong breakout here. However, after the breakout for the first leg, pulls back, and then the market goes sideways. There's no second leg down, so if you're in the market, it's not necessary that you can take a profit, or sometimes you could end up into a losing trade. Why this strong breakout doesn't give you a second leg or the third leg? This is because sometimes the breakout is not backed up by an economic event, so that's why it's losing its steam. If you trade normally as a breakout, you should enter after you see this big bear bar as the signal bar, but the market doesn't go much downward. And then you wait for a second signal bar here, you can also trade, aiming to go down. However, it doesn't go down as well, and then you can do the third signal bar to go down. But when you see the market doesn't go down after the 3 pushes, you want to exit the market and in a good level, so you can take a small profit, or if you can take a small loss. But that's okay, you need to get out of the market as soon as possible. Breakout normally gives very good opportunities to trade. However, sometimes there may be fake breakout. For example, if there's seeming to be a good breakout, however, in the end, the market developed into a big trading range. So in this case, if you do not see the fake breakout, you could lose money. Here's an example. Previously, there was a small trading range, and the market breakout to the upside with this big bull bar, followed by a doji bear bar and then another huge bull bar here. So at this moment, it seems to be a breakout. However, you can see the market later develops into a big trading range here. For the trend to be a good breakout, it has to be consecutive bull bars or bear bars. So in this case, between the big bull bars here, you can see there's a doji bear bar. This is not consecutive breakout. That's why it is not a strong breakout, it is a fake breakout. You may ask, if we go to an upper time frame, then these consecutive bars will become consecutive bull bars. That is right. But the thing is that when you do the trading, you need to adjust the time frame so you can see a clear picture on your full screen. So if this is the right time frame for your trading, you don't want to adjust to another time frame. Then when it shows there's a doji bear bar, then it makes these bull bars not consecutive. So this is a fake breakout. Another way to tell whether this is a good breakout or fake breakout is that we can use the retracement. At the bottom, we have 100% and at the top, we have 0%. Then the market reverses back, you can see penetrates 38% and directly goes to 50%. Normally for a good trend, it retraces like 23% or 38%, but it goes to 50%. That means the upside pressure is lowered. It is not a strong breakout anymore. It depends on which signal bar you're using. You could get into a trade and lose money. If you use the bear bar top as the entry and this bear bar as the signal bar, the next bar penetrates the top, so you're in a trade, but the market goes down, you could have a stop loss. But if you use this bull bar as the signal bar, you can see the market next bar doesn't penetrate the top of this bull bar, so you're not in a trade. No matter which bar you're using as the signal bar, in case you're in a trade, you need to put your stop loss at the bottom of this bull bar here. So you can see the market actually goes down to test this stop loss. So if you're in a trade, you could lose money. Here's another example of the fake breakout. This is the chart for the GBP USD on unemployment rate. You can see that after the news is released, there is a big, huge bull bar here, but with a very big tail at the bottom and at the top. The big tail at the bottom means there is a downside pressure. It's huge pressure to the downside as well. So later on, this is a sign that this could be a fake breakout. As the market develops, you can also see that the pullback here, there are consecutive 1, 2, 3, 4, 5, 6 bear bars. This also means the downside pressure is increasing and then upside pressure is reducing. So based on these two signs, this is a fake breakout. You don't want to trade up anymore.